The big players and CEOs of the crypto industry have experienced massive newfound wealth. But just like the crypto industry, this wealth tends to fluctuate wildly. The son of two Stanford law professors, Sam Bankman-Fried studied physics at MIT and traded ETFs at a quant firm before pivoting to crypto trading in late 2017. He launched FTX in 2019 and grew it into one of the leading exchanges for buying and selling crypto derivatives.
How did you do this so quickly? I mean, your company is 2 years old, and you're doing something like $400 billion worth of volume per month, which is 25 times what you did a year ago.
Honestly, from our perspective, it sometimes feels like the world is just going sort of in slow motion around us, and that we're going at about an average speed by our standards.
In early 2022, investors valued FTX and its US operations at a combined $40 billion. Thanks to his FTX exchange and Alameda research trading firm, Sam Bankman-Fried became one of the richest people in crypto, but his empire, along with his net worth, have now collapsed. On November 2nd, the crypto publication CoinDesk reported on a leaked document that appeared to show that Alameda Research held an unusually large amount of FTT tokens. FTX and Alameda are meant to be separate businesses, but the report claimed that they had close financial ties. Rival exchange Binance announced on November 6th that it would sell its FTT tokens due to recent revelations. In response, FTT's price plummeted and traders rushed to pull out of FTX, fearful that it would be yet another fallen crypto company. FTX scrambled to process requests for withdrawals, which amounted to an estimated $6 billion over 3 days. It seemed to enter a liquidity crunch, meaning it lacked the money to fulfill requests. It was all a big mess for FTX. Days later, Binance said it had reached an agreement to bail out FTX by buying the company. But after back and forth, Binance pulled out of the deal, saying it had arrived at that decision as a result of corporate due diligence. It also cited regulatory investigations and reports of mishandled funds. It's a stunning fall from grace for Bankman-Fried and his company, who had been heralded as a modern J.P. Morgan for swooping in to save troubled crypto firms before its own firm came crashing down. The Wall Street Journal reported that FTX had loaned $10 billion of customer funds to Alameda to gamble with, a substantial proportion of the exchange's $16 billion in assets. The CEO said his first mistake was poor internal labeling of bank-related accounts, which meant he was substantially off on his sense of user's margin. According to a person familiar with the matter, Bankman-Fried told investors that the company was facing a shortfall of at least $8 billion and needed emergency funding.
If we see markets crash again, we're going to see crypto crash along with it. If we see a market recovery, we're going to see a crypto recovery along with it.
FTX has now filed for Chapter 11 bankruptcy in the US. According to a company statement posted on Twitter, Bankman-Fried has also stepped down as CEO. Approximately 130 additional affiliated companies are part of the proceedings. In the 23-page bankruptcy filing, FTX and affiliates said they had more than 100,000 creditors and tens of billions of dollars in assets and liabilities. It is the largest crypto-related bankruptcy ever, and a demise remarkable for its swiftness as well as its size. The bankruptcy has wiped out billions of equity value, leaving investors with stiff losses. Bankruptcy also means that it could be a long time before retail traders and others owed their funds are able to potentially recover any of them, if ever. FTX faces investigations and asset freezes from regulators and prosecutors around the world. Bankman-Fried is also being investigated for potential violations of securities rules. Crypto lender BlockFi, which had obtained a financial lifeline from FTX in July, one of several companies FTX had rescued earlier in the year, paused withdrawals Thursday evening. BlockFi is no longer certain about where the funding for its credit line with FTX US and the collateral for the Alameda loans came from, citing concerns that it could have originated with customer funds. The cryptocurrency industry has long struggled to convince regulators, investors, and ordinary customers that it is trustworthy. The fall of FTX and the pullout by Binance have jolted the market. FTT's price has fallen about 80% since last week. The prices of Bitcoin and Ether, some of the most valuable tokens, have both fluctuated widely since Tuesday, at one point dropping more than 20%. Contagion from the crypto industry into traditional financial markets is still unlikely because institutional investors, always searching for high returns on their investments, are now finding it easier to earn from conventional assets in a high interest rate environment. The fact is that traditional investments, like bonds, are becoming more attractive. This means crypto is less of a systemic threat. While there have been small surges, the crypto market as a whole is largely stalled. While no one knows for sure, some experts say crypto prices could fall even further before any sustained recovery. It's difficult to predict where things are headed long term, but in the coming months, experts are following things like regulation and institutional adoption of crypto payments to try and get a better sense of the markets. Lawmakers around the world are trying to figure out how to establish laws and guidelines to make cryptocurrencies safer for investors and less appealing to cybercriminals. U.S. officials have shown a particular interest in stablecoin regulation, especially following the recent Terra Luna crash. In May, crypto markets went into a free fall that led stablecoins Terra to depeg from the dollar, which in turn caused its linked cryptocurrency Luna to crash as well. Many Terra and Luna investors saw their investments vanish in a matter of days. Within a few weeks of Terra's downfall, the crypto market plunged again, and several crypto companies announced layoffs and froze withdrawals to slash costs due to the extreme market conditions. Some companies like Three Arrows Capital and Celsius have since filed for bankruptcy. The domino effect of that has given federal regulators more ammo recently to push for more crypto regulation.